Welcome to a crash course in tax liens by taxlieninvestorsecrets.com. What is a tax lien? The easiest way to understand what a tax lien is to first understand how the county government works with property taxes. Everyone that lives within the county boundaries is forced to pay property taxes. Those property taxes go to provide a number of different services that each one of us rely on a daily basis. So what happens if an individual doesn't pay his or her annual property taxes? Services such as police and fire departments, education, road construction, the county services themselves, each one of these are all services that are provided for in large part by the property taxes that everyone pays. So if an individual is late paying their property taxes, it actually creates a budget deficit in the services that the county has already agreed to provide. The county needs a way to enforce the property tax system. They need some way to ensure that property taxes will be paid and that they will have the funds that they need to provide all those services that they're constantly providing. The way they do this is by issuing a tax lien against the property itself. Now, they issue a tax lien against the property because it enables them to recoup that lost investment. Here's how a tax lien works. The lien itself is placed against the property. It prevents the property owner from selling it, and it could eventually lead to a loss of property if the delinquent amount is not paid. So it uses that property as security for the delinquent amount. Now, the reason they're able to recoup their investment with this is because tax liens have a set rate of return which ranges from about 10% on up to about 25% depending on which state and county you're working in. And they also have what's called a redemption period. The redemption period is the time period in which the property owner has to repay this delinquent amount before that tax lien could actually be used to foreclose on that property. Now, the way that the county recoups their investment is they hold an annual sale. They invite investors from the public to come to this sale and to purchase these tax liens. Tax liens are purchased for the amount of the delinquent taxes plus any penalties or fees that are associated as well. So if you show up as an investor, you're willing to purchase that tax lien because it's going to pay out an 18% annual rate of return and it has a 2-year redemption period. Now what that means is that the property owner here, Bob, now has 2 years from the date of the sale before the investor can begin to initiate the foreclosure process. So the county awards this tax lien to the investor as security against his investment. So if we're playing out the scenario, we know that from the date of the sale here that the property owner now has 2 years to pay back that delinquent amount before the investor can actually initiate the foreclosure process because of that tax lien. To remove this lien, the property owner must pay all the delinquent taxes back, including the 18% rate of return that will be going to the investor. So there are penalties and fees that are associated with paying your property taxes late. So let's play out the scenario here of the property owner paying back all the delinquent taxes and fees, which on most properties the value is exactly what's going to happen. No one wants to lose their property due to some delinquent property taxes. So let's say that the property owner pays all of the taxes along with any penalties or fees to remove this lien. Well, in this case, the county will remove the lien from the property and will cut a check to the investor for their initial investment plus the set rate of return that they were guaranteed, which in this case would be an 18% rate of return. Typically, counties will cut these checks within about 5 to 10 business days. So what happens if the property owner doesn't pay back the delinquent taxes within that set redemption period? Well, the tax lien itself, because it's been placed against that property, actually can give the holder of the tax lien the right to foreclose on that property if the property owner doesn't pay that delinquent amount within that set redemption period. So it can actually end up giving the tax lien holder full ownership rights. There are really only two possible outcomes for a tax lien investor or for a tax lien investment. Basically, the property owner is either going to pay the delinquent property taxes back, or he or she is not going to pay the delinquent property taxes back. If the property owner pays the delinquent taxes back, then as an investor, you make an 18% rate of return in this example. If the property owner doesn't pay back the delinquent amount before the redemption period passes, then the investor has the right to initiate the foreclosure process and can actually own that property outright, free and clear of any other encumbrance.
Tax lien investing, pros and cons. Hi, I'm Phil Pustiowski with FreedomMentor.com. I'm a real estate mentor, full-time investor, author of the book How to Be a Real Estate Investor, which recently hit #1 on Amazon, bestseller. And in this video, I am going to break down on a more 30,000-foot view the pros and the cons of tax lien or tax lien certificate investing. What's a tax lien? In simple terms, it is when a person does not pay their property taxes. What happens is the county, as opposed to, say, hiring a collections firm and bugging the heck out of that homeowner, instead what they do is they literally ask investors to pay the person's bill. And what the investor gets in return is a tax lien certificate from the city or from the county that states that they're not only going to get their original investment back, and you know, the typical cost of somebody's property taxes for a year, and you could probably figure it out for your own area, you know, it's $1,000, $3,000, $5,000, $8,000, depending on the area. So not only do you get the original investment, because you basically paid that homeowner's bill, because the county needs money. So you paid their bill, so you not only are going to get that money back, but you're also going to get an interest rate or a rate of return. Now, the first key lesson that you need to be aware of when it comes to tax lien investing is that it's very area specific. The rules are completely different from county to county to state. Very, very different. Now, each state has like certain, I would say, global rules, but then on a more county specific level, there's even more greater details of rules. And so what that means is every area is different. Some are going to be better than others. And what I mean by better is the ability to get more of a rate of return. Okay, that's where the better comes in. And then in some cases it can be easier than in others to actually become the owner of the property if the person doesn't pay back their taxes. So that's where we're going to move this conversation, because this gets real interesting in the real world. And by the way, what I'm going to share with you is not regurgitated from a book or another training. This is what we have discovered over a lifetime of experience. And I'll give you one more disclaimer. I personally do not buy tax liens, okay? So I'm not saying that necessarily jades me one way or the other, because I have friends that own over $500,000 in tax liens each year. They buy them and then the other ones get paid off and they just go buy more. So I know the pros and cons, and I'm going to talk about those, and you'll also learn why I don't invest in them. Okay, so tax liens, or tax lien certificates, they're going to be in that 2 to 5, 8,000 kind of range. Now, sometimes it's a big commercial property, and it might be like 100,000 or 150,000, but in most cases it's not. Let's talk about how you get there. Well, you get there if somebody doesn't pay their property taxes. Who's most likely not to pay their property taxes? Number one are the people that don't have a loan against the property. So that's a pro, okay? So on the pro side is that you're going to get some properties that potentially have equity, okay? I'm going to come back to this too. There's two reasons why this is helpful. So a lot of the time these properties don't have a loan on them. Why? Because a lot of the people that get a loan or a home loan to buy a property, typically the mortgage company is paying the taxes each year and the insurance. And even if the homeowner doesn't even pay their mortgage, the bank still pays the property taxes and the insurance. So typically when there's a loan against a property, typically the taxes are being paid and you won't see these property tax lien issues. But if the property is owned free and clear, you definitely can run into that. Now, what kind of properties are owned free and clear? Obviously, you have those that have been owned a long time. by one owner and they've paid off the loan. You see where sometimes the property gets inherited by an heir, and those are the most likely ones not to pay the taxes because they just inherited this wonderful property, but they may not have the extra $6,000 a year to pay the taxes. There's other ones as well. What about the don't wanters? What about the properties that they don't want? So one of the cons is you've got to be very careful about, I would call them misfits. These are properties that the owner just doesn't want. Maybe it's some weird sliver of land that's completely landlocked, and it's just a whole bunch of undeveloped trees or something, and it would not only be difficult to sell the trees to a logging company, but you couldn't even get in there because it's landlocked. I mean, this happens a lot. So many of these properties are weird misfits. They're slivers of land, raw land, vacant land, things that the owner themselves don't want. And so they look at it and say, well, who cares? I'm not going to pay $2,000 a year for this property. Let the city take it back. I'm not paying nothing. And so some of these properties just stay in this perpetual cycle of nobody wanting it. And and sometimes the city actually takes them over. Nobody actually ends up paying the taxes. Nobody buys it at the tax deed sale, and voila, the city becomes the owner. So you get these misfits. And what happens is there's usually a period of like 2 to 3 years. So if you don't pay your taxes the first year, a tax lien gets issued. Then the next year, if you don't pay, a new tax lien certificate gets issued. Now that gets important because if you buy the first one on year one for, let's say, $3,000, but you don't have money next year to invest in that one, well, then you get put on the back of the line in case the owner never redeems or pays back the back taxes. You can put you in an inferior line or role to potentially become the owner of the property, which is a small segment of this overall investing strategy. Is that if you do pay for the tax lien certificates, you have the option of potentially becoming the owner, but that's going to depend on the state. Because I know in my area, here in Florida, what happens is if the person doesn't pay their taxes for, say, 3 years, what's going to happen is it's going to go to a tax deed foreclosure auction. So the only way I'd get it back as being the tax lien owner is if nobody bids at the auction, which is kind of scary. Because what that means is nobody wanted it. And then all of a sudden, I'm stuck with a property that I don't want, that I got to now pay taxes on, that nobody wanted to buy at the auction. So this goes back to this con. You could get, potentially, you get stuck with one of these. So that means that if you're interested in investing in tax liens, you're obviously going to have to evaluate each property individually to see which one you want to potentially buy the tax lien certificate for. Now, in my area, they issue the list once a year. There are 21,000 tax lien certificates that they sell in a year. And they do it once a year. So that means you have to cull through all 20,000. Now, maybe you have a budget of, say, 20 grand in a year that you want to invest in these kinds of things. So I guess you would just go down the list until you hit about the first 20. But remember, you may lose on that auction. So you've got to have some backups. So one of the, and I don't know if this is a pro or a con, but part of this is that you're going to have to evaluate before you make the decision to put the money into a tax lien certificate. Because you need to know what it is that you're putting this money against. And if you're putting that money against some weird sliver of property, you may end up with it. And you don't want that. Because if nobody else can buy it at the auction, you don't want it. Now in other cases, in other states, you may want the property. And now this is where things get really interesting. Another potential con of this is going to be competition. Okay, so obviously, if it's such a good idea, everybody's going to do it. Well, this requires some real money. You got to have some money if you're going to buy tax liens. So the competition is typically banks, like local banks, hedge funds. And here's what they do. They cherry pick usually for the single family homes, or the single family homes or properties that have a big mortgage on there. Because if the tax lien doesn't get paid after, say, 2 or 3 years, depends on the area, potentially that mortgage could get wiped out. So these mortgage companies will come in and make sure and pay the tax lien right before the tax deed sale. So banks, hedge funds, they love this because, maybe they get 2, 4, 6, 8% on their money. Maybe you've heard there's places in this country that'll give up to 20% guaranteed rates of return, or 25%. Well, that's where the bidding usually starts. And then it usually bids down. And so you're bidding against other people on the interest rate. So the interest rate may land on 6% or 8% or maybe 10%. So, but again, it depends on the area. And again, this is where we get a little technical, because each area is just so much different than the next that you have to know the rules. And we'll talk about how you figure out the rules here at the end. So you're going to have competition. And that can be a challenge as well, because you're going to be dealing with people that have been doing this a very long time that know a lot more about this than you do. So that's a big con about this whole thing, is making sure you can weave and bob in and out of the competitors. And remember, these competitors probably have a lot more money than you, especially these banks and hedge funds. I mean, they may have like unlimited funds to buy these things. So it also depends on the property and what's going to happen with it. So again, like I said, a weird sliver of land, that's a little bit more of a red flag. But a single family home with a big fat first mortgage on there, it's probably going to get redeemed. If not by the homeowner, at least the bank's going to pay back that money before it goes to foreclosure and they lose their first mortgage. So if that's your goal, great. But then your goal might be to try to pick off a couple of these properties. So then you're going to want to take the approach of finding the deals that are least likely to get redeemed. And how do you do that? Now I'm going to give you some really good tips here. The first is, go to these tax auctions for a while. If you have any interest in investing in tax liens, study them. Study who's there. I know in my area, typically there's 3 companies that buy like all of them. They do it all across Florida. There's 3 big companies and they buy them all. And so that's their business though. So figure out who the competition is, what they're doing, and study it. Study what happens to these properties. Study, and you can do all this, and it's going to take time. But you notice I'm not telling you to go buy some course on tax lien investing. I'm telling you to go study your local knowledge, because that's where the wisdom is. I think it's also a good idea for you to go talk to an attorney that handles tax foreclosures. So in other words, if you are the tax lien owner and you need to get your money back and they didn't pay you, oftentimes you can file for a quiet title or for a tax foreclosure. Find out who's handling those and learn from them. There's going to be some local providers that handle this for the people that are there right now. In fact, if you went to an auction, you asked around, what attorney to use, what title company to use, because one con can be getting clear title. Getting clear title can be a challenge in certain states and certain areas. In Tennessee, it was a very big problem. In Florida, there's actually some closing companies that just focus on clear title for tax foreclosures. So you'll have to definitely get a better understanding, and that's where these local service providers can give you some great wisdom on this subject. Again, you can really dig in and learn what's going on. And again, like I said before, it's much better if you know the property you're dealing with. So I don't know if this is a con or not, because every investment you've got to verify if it's a good idea. But I guess the part of the con is just that you have to go through so many to find a few that are going to be winners, that are going to be a good use of time. You're definitely going to have money. Okay, this is not a game for no money, no cash down, creative financing stuff. You got to have the money. Now, I personally don't put my own money into it because I can use that money and make a lot more deals out of it. So in other words, if I was going to take $10,000 and throw it at a tax lien, I could take that same $10,000, give it to a homeowner, of somebody who has to absolutely get out of their house today, and then I could turn around property, and flip that property for a lot more than I put in, so I can get a much better rate of return. However, I know people that have been, ex-venture capitalists, ex-investment bankers, and they're sitting on several $1 million, and so they don't want to, they don't want the hands-on that's required that I do when I'm doing my regular investing. So they just go buy a bunch of tax liens, and maybe they get 6 to 8% on their money. They focus on single families that they know they're going to get redeemed. They don't have to worry about getting the property back, and that's the way they roll. So, what's a pro? In a lot of cases, I'm going to argue it's hands-off. Now, it's not hands-off in the beginning when you have to actually choose which one you're buying. but it becomes hands-off once you buy it. You set it, you forget it, you move on. So that's definitely a benefit. And I suppose we need to talk about the pro of a guaranteed, interest rate. That's nice. But I am also going to argue it's a lot like a bank CD. A bank CD meaning you buy it, and then you're going to have to wait a couple of years before you can get back to it. My brother is a financial planner, and he would call it liquidity. Not very liquid. Because once you buy it, you're going to have to sit on it. And, you could even sit on that thing for 3 years before you end up getting your money back. But it's a good rate of return, right? So it's not all bad. All right, so those are really the pros and the cons of tax lien investing. Now, like I said, I don't do it because I have a better place to put my money. I do like to check out those tax deed auctions in the states that they do have them. That can be a good little niche. And where they get really nice is this. When you get a situation where somebody passed away and the probate hadn't been handled all the way, or they haven't fully transferred the assets over to the heirs, or there's some sort of disagreement, and meanwhile it's barreling towards a tax foreclosure, maybe it goes to tax foreclosure, and sure, you have to compete against the other guys who are bidding at the tax deed sale, but sometimes you can get a pretty good deal there. And that can be a great little option. That's going to be, that's where I'd rather be in the game, is more on that side, because I'm okay with the hands-on. I don't need hands-off because I'm already in the flow of deals every day. So I want to be in the flow so that, I don't want to get 6 or 8% return on my money. I'm going to do a lot better than that in a year, that's for sure. And again, certain parts of the country may do a little bit better. So I hope you enjoyed this video, and hopefully I shared with you some insights that you wouldn't hear in other places. Because this comes from the School of Hard Knocks, and we've just been through this so many times. We know where the benefits are. And I'll say this, and I've talked about it earlier in this video. It's all about local. So if you study this thing long enough in your local area, you talk to enough professionals who are doing it, you'll eventually begin to see where the opportunities are.
Hello, I'm going to quickly share with you how to buy tax lien certificates. But first off, let me just explain what a tax lien certificate is. A tax lien certificate is nothing more than a lien on a property for not paying taxes. See, every year real estate homeowners have a tax lien placed on their real estate. And if the property taxes are paid on time, then that tax lien is removed. If they're not paid in time, then the county will actually allow investors to pay on behalf of the homeowner. And what happens is the winning bidder, obviously these go to auction, and the winning bidder at the public tax lien auction gets a tax lien certificate as proof of the purchase. And as the owner now, if you're the highest bidder, the investor has two possible outcomes. Number one, they can get a guaranteed annual return on whatever it is they paid for that tax lien certificate, and that return ranges anywhere from 8% clear up to 25% or even more. The other option or outcome is through foreclosure, they can actually become the owner of the real estate free and clear. And that's ultimately what everybody tries to do, is buy a free and clear property. Now, I'm going to really quickly go over a few things, 10 steps, on actually buying a tax lien certificate now that we understand what a tax lien certificate is. The first thing that you're going to want to do is you need to identify your goals. What is it that you're working with? How much money do you have? How much time? What are the different resources that you have available to you? You really need to figure out and identify your goals, because it can be very expensive when you invest in tax liens if you're not prepared. The next thing you need to do is you need to identify your investment strategy. Now, what this is basically your strategy. You have two options. Number one, is your investment strategy a quick get an annualized rate of return? Or is your investment strategy more of the, hey, I want to acquire properties? So depending on your investment strategy, you're going to choose a specific state that actually aligns with your investment strategy, because every state is different. And that's step number 3. You need to choose the right state that aligns with your investment strategy. Every state has its own annualized rate of return, and it varies anywhere from, like I say, 8% all the way up to 25% and even more. So you really need to determine what is your investment strategy so that you can choose your state. Some states are better in a sense where you have a better opportunity of ending up with the property if that's your goal. So you want to consider the annualized rate of return. The other thing that you might want to consider is the length of the redemption period. There's a certain time frame that the states give you, or the actual property owner, to redeem that so that they don't lose their home. What is that length? You also need to consider your investment budget. How much do you have to invest? Because these properties are going to cost money and also take your time. Also, consider the date of the auction. Sometimes some states have auctions every month. Other ones, they have them once a year. So depending on that, you might want to adjust your investment strategy. Consider also the state laws and the different statutes as well. And number 4, the right county. You want to choose the right county within the state. Certain counties have a lot more tax certificates than other counties. And so you want to prepare and find out what counties have the highest volume, because that's going to give you the best opportunity to find the actual tax lien that you're looking for. And then once you've identified that, then what you're going to do is you want to get a tax sale list. And for some reason, this seems to be where a lot of people have trouble. And there's actually lots of different ways you can get a tax sale list. Number 1, you can obtain it directly from the county. There's a person or individual in charge, usually it's the county treasurer. You can just call them up and say, hey, I would like your most current tax lien listings, and they'll send them to you. You can also grab a newspaper. And then finally, you can also talk to some list brokers out there. There's actually lots of places you can go online to get those. And you're going to find lots of different things. Once you see these listings, you're going to see things like the parcel numbers, you're going to see the owners, you're going to see the legal description, and things like that. It's really going to help you out. Now, once you've obtained that tax sale list through one of those methods, then what you're going to do is you're going to start doing your due diligence. Now, believe it or not, there are some things that you're going to want to do, because again, when you find the right opportunity, the right tax lien, you're going to want to invest in it. And there's also reasons that you need to stay away from certain tax liens that you don't want to bid on. And so the due diligence is really very, very important. Here's a few things that you might want to consider when doing your due diligence. Number 1, the whole budget issue. Is it too far out of your budget? Okay, keep that in mind. Number 2, the zoning on the property. Number 3, if it's improved or if it's unimproved. There's a lot of tax liens out there that you can actually buy that's in the middle of a street somewhere, and it's not of any value. So you've got to do your due diligence. Number 4, the assessed dwelling value is at least 70% or less of the gross assessed value. So bottom line is you want these properties to have value. And lastly, you really need to make sure that they're free of any liens or encumbrances to where you've actually got to pay more money now in order to get the property. So, and then, you know, it's also not a bad idea to actually go out and visually inspect the property, because there are also risks in place. And you know, a couple of the risks just off the top of my head that I can think of is hazardous material. Sometimes you don't know why people are not paying their taxes. Maybe there's some hazardous material that they found on the property, and right now, as it stands, the property is not worth what it would cost to fix up or to take the hazardous material off. And so there are some risks, even though there's very few, and tax liens are very safe. Again, it's the due diligence, and then also knowing the risks that are involved. And then finally, once you've done that, then it's time to purchase. And what you'll need to do is beforehand, you can go down, and a lot of these sales, they have a specific process, so that if you are the high bidder, they expect certain things to be done a certain way. For example, some auctions, they might want you to have certified funds within 24 hours, very similar to a foreclosure auction. So it's important to know, once you do purchase it, what you have to do to get the money. So usually it's within 1 day. And then once you own it, you sit back and you wait. You manage your investment. There's not a lot to do. You just sit back and wait, and eventually you profit from it. The money comes in, and if they pay it, great. If they don't, then you actually have the option through foreclosure to end up with a property that's free and clear. Hope this is.
Hello and welcome to Secrets of Tax Lien Investing. In today's video, we're going to talk about what is a tax lien certificate and how do they work. Now, the definition of a lien is a claim against an item which affects the ability to transfer ownership by another party, which utilizes that item as security for repayment of a loan or other claim. Now, tax liens are the enforcement method used by the government for the collection of property taxes. Tax liens are liens against real property. Now, they can be offered to investors that are willing to pay off the delinquent taxes. They can either be sold at a live auction or you can purchase them over the counter. Now, tax liens pay investors a rate of return, and they also give property owners a redemption period to repay the taxes. Also, the tax lien certificate has foreclosure rights. If the lien is not paid back within the redemption period, the lien holder can foreclose on the property and become the new owner. Now, the tax sale cycle is really the process that the county government will go through. In this example, we can see the property owner Bob here. He has to pay his property taxes to the county government, and in turn, the county government pays for all the services that we use. Things like the police department, the fire department, schools, the roads. All of this is paid for by the government through property taxes. Now, what happens if Bob here doesn't pay his annual property taxes? The first thing is the county will issue a tax lien certificate against his property. We can see this tax lien certificate here has an 18% interest rate with a 2-year redemption period. So the county is going to hold an annual tax sale, and they're going to offer investors the chance to purchase tax liens at a high interest rate return. So really, two things will happen soon as that tax lien is issued and sold at the sale. First, the lien will begin accruing interest. So if we're looking at an 18% interest rate, that's going to be about 1.5% per month. Also, the redemption period will begin at that time. Now, of course, we know the redemption period is the time frame that the property owner has to pay those property taxes off. If not, the tax lien certificate holder, the investor, can foreclose on that property and become the property's owner. So if the property owner pays, if Bob here pays all of his delinquent taxes, his interest, and the fees to remove the tax lien, the county is going to cut a check to the investor for his initial investment plus his interest rate return. But if the property owner doesn't pay, if Bob decides he doesn't want to pay the tax lien certificate, this lien gives the lien holder, the investor, the right to foreclose on the property once that redemption period is expired. So in this example, we would have a 2-year redemption period. If Bob didn't pay back the tax lien certificate within that 2 years, the investor can go ahead and foreclose and become the new property owner. So tax lien investing really has 2 possible outcomes. Number 1, the tax lien certificate will pay the investor their initial investment plus their interest rate return. Number 2, the property owner will not pay, and the lien holder forecloses on the property and becomes the new property owner. Tax lien investing is really a win-win solution for everyone involved. Property owner Bob has a time frame, a grace period, that redemption period, before he's going to lose his property. The county is able to get the funds they need to run the county government. They set a budget based on those funds, and they need to have those funds to run all of the services that the county takes care of. And also the investor is going to earn an interest rate return on their money. So it's really a win-win situation for everyone involved. There are several different states that you can invest in tax lien certificates. You can see some of the states listed here. Some of the hot states are Arizona, Colorado, Florida, Illinois, Maryland, South Carolina. There's lots of great states to invest in tax lien certificates, and you can see some of
Welcome to the Internet-based investing for tax deed properties, brought to you by TaxLienInvestorSecrets.com. These trainings typically go by pretty quickly. This one is focused on Internet-based investing, and so if you need to, pause the video, or you can always come back and listen to it again. It'll be short, roughly about 10 minutes long. The first step is to go to www.naco.org. Now, this website is the National Association of Counties website. It's one of the best tools out there for locating county information, especially county websites. Now, on the left-hand side, you'll see that there is a tab there for About Counties. If you put your mouse over that tab, a drop-down box will show you a number of different options here. You're looking for the Find a County option that the arrow is pointing to. By clicking on that one, you can now see a color-coordinated map of the U.S. Each one of the states is a separate link. Now, for this example, we're going to click on the state of Florida. Each state has its own website, web page, and that includes a list of all of the counties within that state and the population and the size in square miles of each of those. Now, the state map can be very helpful if you're trying to determine exactly where a county is located within a state. Now, a little bit further down the page, we see more counties. For this example, we're going to click on Hillsborough County. Each county also has its own page. Now, this page includes contact information for the county, email addresses of some of the elected officials, and more information. However, probably most importantly, it also has a link that will take you directly to the county website. This is the Hillsborough County website we're looking at right now. We're looking for information about tax sale properties. We're looking for tax deed properties specifically. Florida is one of the few states that actually sells both tax liens and tax deeds. And so their deed sales take place in many counties on a monthly basis. So the easiest way to find information about the tax sale is to make sure you're looking in the right department. This is usually delegated to the county treasurer or the tax collector. So we're looking for the county treasurer or the tax collector. In this case, we're going to click under Other Government Websites. And right down here towards the bottom, we can see a link for the Hillsborough County Tax Collector. Now, this is the tax collector's actual website here. The resources we have right here available to us are great. Number one is the site search tool. A lot of times you can type in a keyword such as tax sale or lien or deed, and it will pull up information that you can use to find out when the properties are going to be sold, or more information about the sale. However, in this case, we can actually see on the left-hand side there is a link here for property taxes. So we're going to click on this one and see what we can find out. Now right here in the middle, this is a section of the website that's probably helpful for citizens of the county, but right in the middle we can see that there is a link there for property tax certificates. Now by clicking on this, we see at the very bottom of this now exactly what we're looking for, and that is the tax deed sales and lands available information. It also says below that there's a link to the clerk of the circuit court, so we know that the circuit court in this county is the one that handles the tax deed sales. Now, by clicking on that, it took us to the clerk of the circuit court's home page, and we can see here, if we scroll down the page a little bit under online services, we can see tax deed sales. We're going to go ahead and click on that. And right here, it takes us to the current page we see right here. And on the top part of this, you can see to view the current tax sale list and lands available, click here. This would be a pretty easy little section to overlook. The click here is the actual link to view the lists of lands that are available. So oftentimes these things are going to be very easy to look over. You need to dig into some of these websites and pay close attention to every line. Now this takes us to a tax deed search program. Now this allows us to search by sales date, which is probably going to be the easiest option for us. Now the search criteria is based on the date of the sale. That can be either past or future. Each date represents a separate sale. Now for the 12/10 auction here, so again this is set up under the sales date here for 12/10, we can see a list of available parcels. Now the actual certificate number here is a link to more information that the county has about this actual property. So we'll click on the one that the arrow is pointing to, and we can now see that this is a property that has a base bid of $9,130. We can also see additional information, including more links. We can see a link here for the tax collector, and we can also see a link for the property appraiser. We're going to click on the property appraiser because the property appraiser's link will give us information about what that property is valued at. Now the appraiser information tells us a lot of things here. Number one, we can see that this is a Florida sale, but the mailing address is in Philadelphia. So it's obvious that the owner lives out of state. That can be a good thing for increasing your chances of acquiring property. We can see here that it's also valued at around $130,000 as far as the assessed value goes, and that it's zoned as a single-family residence. The sales history tells us that the property was gifted to someone in 1988 for $100, and it also tells us that it was sold in 1989 for $65,000. Now, scrolling down a little bit further, we can actually see the physical address for the property as well as information about the building, such as the year built, construction type. We're going to want to copy that physical address to find out more information about what exactly this property is worth. We're going to enter that physical address to the property that we just copied on one of the websites out there that we can use for evaluating property values, such as Yahoo Real Estate, or it could be Zillow.com. We're going to take that and we're going to enter it in right there. And we can see that this property has an approximate value range of $153,000 to $160,000. Again, the starting bid is $9,130. Now, you're also going to want to click on Zillow or look at some of these other links here to find out more information about this property. Through the Zillow link, we can now see a satellite image of the actual property itself. Based on the available numbers that we have, this property could easily have a profit potential of close to $100,000 depending on what the investor purchases the actual property for at the deed sale and what the actual property value is based on the area.
And what I'm going to show you on this free tutorial is how you can do 5 minutes of investigatory work before you go out to look at any property that will save you tremendous time going forward. I've been seeing an alarming thing going on within the housing market within the last 6 or 7 months, that most of the properties that I go and look at have some form of encumbrance or liens on the property. And I learned the hard way about 7 months ago when I actually put an offer in on a property, and we got down to the last minute, so to speak, and I found out they had all these encumbrances when the title search came back. So I put a lot of time into a deal, and what I should have done is harness the power of the internet and do 5 minutes of investigatory work to look and to find out if there is any encumbrances that I can possibly find out about before I go and look at the property. Even though you may work with a realtor, he or she may not have this information. So it's been my policy, and it's my golden rule now, before I go out to look at a property, whether it be a short sale, lease option, or probate, I do a little mini title search myself. And anybody can do what I'm going to do as long as your registry of deeds is online. And all you would do is go to a Google search engine such as this and type in your particular registry of deeds. In this case, and in this tutorial, I'm going to be using the Worcester County Registry of Deeds. So if I were to type that in the search bar up here, Worcester, it comes right up. I'm going to click on that, and here I am, Worcester County Registry of Deeds. Okay, and I want to direct your attention over to the left sidebar here, and there's a lot of resources that you can find out about, but what we're interested in this particular tutorial is to click on Search Our Documents. Okay, now you'll notice you have a box here with some tabs, and it says Name Search, Document Search, Property Search, Certificate Search, and actually unindexed property search. Now you can use this for a number of different searches, but we're going to concentrate on what you should be doing before you go to look at a property. That way you have the information that if you are going to crunch the numbers and that particular property meets your investment criteria, that you're going to have that information already in the back of your head, that you may have to figure in IRS liens, judgments from a court, maybe the owners of the property got sued and they got a judgment against the property, mechanics liens, municipal liens, municipal utilities that haven't been paid, so they put a lien on the property. You need all this information at your disposal so you can make an educated offer in something that meets your investment plan. That way you're not at the 11th hour, you put 70, 80 hours into a property going back and forth, because we all know that at the 11th hour something always pops up. So why not do away with a little bit of stress for yourself by just doing this, and then you can make an informed decision on whether you should go look at the property or not. So there's two ways that I do it. You can either go by a name or you can go by a property search. Chances are you're probably only going to have the property address, so you would click on property. Okay, and in this case we put a street number. I'm going to use 41 as an example, and then I'm going to use Beaver and Clement Street. Let me go back to here and type that in, Beaver and Clement Street. In particular in Worcester County here, a lot of times they'll make you put cross streets in order for it to pop up in the index. Just before I started recording this tutorial, I just typed in Beaver Street and it came back with 0 searches. But when I put Beaver Street and Clement Street, you'll see in a minute what happens. Description, you want to leave that blank. If you didn't know what town or city it was in, you could just search all towns, but in this case I know it's in Worcester, so I'm going to click Worcester. And here the search dates. The first archive that they have online is as of January 1st, 1966, and goes all the way up to today's present date. So I'm going to click search, and lo and behold, we have a lot of activity on this property. So generally what I'm looking for here in this mix here is maybe something in the last 10 years. Okay, I'm looking for any judgments, any municipal liens, anything like that, discharges, because if you have a discharge, usually you're being discharged from something such as a lien and so forth. Since I don't see any of that activity here, I'm going to click on this top one here. The file date is March 13th of 2002, and I'm going to get a kind of an idea of what's been going on with the property as far as how much is owed on it. Okay, so I know here that this property Right now it's mortgaged for $116,700, and this is some of the same things that a title company will do. Granted, they'll do it in more depth, and they'll really go over each line and of each document that's listed with this property. But even they can make mistakes sometimes, and that's why you buy title insurance. But that's another topic for another day. Okay, so we have 41, which is the building address, and we have Beaver and Clement Street. Beaver is the regular street, Clement Street is the cross street, and then we can find out who owns the property, who the mortgage and or the bank company is. Okay, and down here is other reference documents. Okay, now sometimes you will see those encumbrances here too. Now, I see an assignment here, so that kind of piques my interest. So what I would do is I would click on the assignment. Okay, and it tells me that consideration was 0, and it shows it goes from Mortgage Amenities Corporation, and then the grantee is Mortgage Electronic Registration Systems. This tells me that more than likely it was a refinance. Okay, so if I want to look at the document itself, I come down here and it says Quick Document Viewer. Click on that, and lo and behold, here's the document. Assignment of real estate. So that indeed is what happened. It's just a refinance. Okay. All right, now I know the person's name. It appears to be John K. Bryant. Yes. So what I can do now is I can go back to where I originally was. Okay, and I can do a name search. So this kind of cross-references everything for me, because I found that sometimes what happens is that you'll do a property search and one or two things will come up or nothing will come up. But if you type the person's name in, like what we're going to do now, Bryant John. Okay, and what we're going to do is we're going to put him down as the grantee. We're going to look for all documents, and we're going to go to Worcester again. And what this will do is it just kind of double checks our work. It's like when you were in school and you double check your answer with arithmetic. Same thing here. Okay, I'm going to leave these alone. I'm going to hit search. Okay, I get one back, so I click on that again. Okay, and it shows me basically the same thing. Okay, except this only shows the original deed for $98,000. Okay, because you remember the last document we saw, the deed, it showed there was I think $117,000 and some change. Okay, but don't get sidetracked on crunching these deeds and so forth. All you're looking for is things that have municipal liens on them, judgments, anything like that. You'll see them. They'll be bold and clear. You'll see municipal lien. You'll see judgment. And that's what you want to get into, and that's what you want to write down of how much is owed on that particular lien or judgment or encumbrance, and that way you have that information when you go to look at that property. If you have any questions, feel free to email me, coach@jgage.com, coach@jgage.com. I hope this was helpful to you in your investing, and until next time, be well.
And so let's go ahead and talk about some property research when you're getting into tax lien or tax deed investing. So I want to talk about kind of your foolproof plan in this, okay? So, especially when it comes to tax lien. So let's talk about tax lien investing research right now. So let's say, for example, you're looking at a tax lien on a $100,000 property. And let's say the tax lien is like $1,000 or $2,000 on that property, okay? So you're gonna research the tax lien. You're gonna make sure that the house is pretty decent. Hopefully you can see the property physically. If not, you can have somebody go there and take pictures of the property for you so you can see that it's livable and in good condition. So what we want to do is make sure our butt's covered, okay? And here's how that looks like, especially with tax lien investing. You always want to make sure that the worst case scenario, so here's the two scenarios with tax liens. Scenario number one that happens like 95% of the time is the tax lien certificate redeems and you get your interest rate. So that's why it's one of the most proven, safe and secure investments in North America, because 95% of the time they come and pay you back with your interest rate. Now, the other 5%, is really where people get the massive home runs, is because you own a tax lien for $1,000 or $2,000 maybe on a $100,000 home, and what happens is they don't pay you, so you go ahead and you foreclose. So let's say you're into this thing for $1,000. So you hire a foreclosing attorney to send out all the notifications, go through with the foreclosure process, and you now own the property free and clear because the mortgage gets wiped out. Now remember, the mortgage company is often who redeems most of the tax lien certificates. And that's because obviously they have a mortgage on it and they're going to get wiped out. So what you're going to do, you're now into this property, assuming the tax lien didn't redeem, you're foreclosing. So you're now into this property for about $2,500. Let's just say $3,000 at the end of the day. What happens with most people is they're able to go ahead and flip this thing super fast. You know, if the market value is 100, you can easily sell it for, you know, $65,000 tomorrow, or even $70,000. $30,000 below market value, that thing will move super quickly. Now, remember, I'm always a big fan of selling these things quickly because when you sell at a deep discount, you are dealing with investors, people that know what they're doing. They buy fast, they close fast, and they have cash. Now, a lot of people get greedy and want to put these things on the market for full market value. So what happens is all of a sudden you're competing with every other mom and pop that are wanting to sell their house and move into a bigger house. And you're now competing with every other house on the market. So that's why it's best to sell it fast and flip a whole bunch of these things. So back to what we were discussing before. Now let's talk about the absolute worst case scenario and how you can still come out of this thing ahead of the game, okay? So let's say the worst case scenario is you buy it and you foreclose and you get it, and then maybe that thing burns down or something happens during the redemption period where this thing has to be demolished, right? Maybe there's a flood or something like that. And you always want to make sure that the land value is going to cover all of your expenses. So on a $100,000 house, the worst case scenario, which rarely happens, this, I don't even really know anybody that this has happened to, but if you're like me, you always want to know the worst case scenario, okay? So the worst case scenario is this. You buy it, you foreclose on it, and during some time in this, it burns down and you have to have a demolition crew come in and clean it up. So, you know, the property, you're now into it for maybe $6,000. So the worst case scenario is you always want to make sure the land value is going to cover your butt, okay? So worst case scenario on the tax lien, you sell the land, you recoup all of your money, and then you move on to the next and chalk up the lessons. And you're going to get some massive lessons through this stuff. So this is why I always say to people, why it's so important, you know, even if you're just buying like a $20 or $30 tax lien, it's so important to get that experience and get comfortable with this stuff, because it's not really a matter of when you're going to get something that hits and maybe makes you a lot of money. It's, it's not really a question of if, it's always when. That's what I always say to people, because so many people go to their first sale and think, oh, you know, I didn't get a property, this business doesn't work. And it's not like that. You know, I obviously have a lot of stories of people getting massive success at their first sale, like buying 5 or 6 tax deeds or getting a bunch of tax liens and then foreclosing and getting the house on their first one. Sometimes you're going to go to a sale and you won't get anything. And, you know, you need this experience. Obviously this business, I love this business because I really think tax liens and deeds are the best barrier to entry into real estate, because there's no wild card variables, I call it. There's no buyers or sellers. The county deals with everything for you. You show up, you bid, it's done. You don't have a buyer or a crazy seller to go and blow the deal on you. So that's why I really like this business, okay? But too many people just give up too easily. They think they go to one sale and they didn't make $1 million bucks, and then they say this stuff doesn't work. Well, you need to get experience and get comfortable with this and start to understand and, you know, feel familiar with this. You know, you wouldn't hop in an airplane with a pilot that's only flown a plane once, right? So that is very, very important to stick to this stuff. Get some sales under your belt. That's why in the last video I talked about going to the local county sales, and, you know, even if you're not willing to want to buy, just getting used to the environment, getting used to doing some research and understanding this stuff. So if you stick to that, you are going to be in great shape. So On that note, to recap, these are your action plans once again. Try to find a sale, just go to it, get comfortable, or even research a sale. Take any sort of action after this video, and you're going to be moving forward to getting a lien or deed and then selling it and profiting. So to recap, just always make sure the land value is going to cover your butt if the worst case scenario happens. And I have thousands and thousands of customers all over the world, mostly in North America, and I've yet to hear a story of this worst case scenario happening. However, I just wanted to make sure you're covered in case it ever does happen. You'll still come out of this thing ahead. So thanks for watching, and I'll see you in the next video.